different things happening within, just different developments and reasons why I think you should invest in different areas in Austin. And so we'll go from there. I'm going to go ahead and go live now on Instagram. And in theory, once we go live, we should be able to get this thing going. All right. So it would appear we're live right now. And here we go. Hey, there it is. Here we go. All right, guys. Again, welcome. My name is Paul Smith, and this is your 12 at 12. 12 o'clock every Wednesday, we're doing just a quick kind of Q&A with myself, Paul Smith, owner, founder, one of the owners and founders of 12 Rivers Realty. Been in real estate now 20 years, specializing in everything from investment real estate to development and everything in between. You've helped folks first-time home buying process all the way to people that I've sold hundreds of homes with. So really kind of running the gamut when it comes to the Austin real estate market. And, along the way, I've jumped into different things entrepreneurially, invested in a couple different restaurants, partner in one called Toshikon. We're currently named in the Michelin Guide. It's a 6-seat sushi restaurant. So if anybody's interested in grabbing some sushi, let me know. We typically drop our seating it's the month before, and we sell out pretty quickly. But the nice thing is that if you hit me on a DM, I can get you in there and kind of like as a jump the line thing. Man, Ray, what's up, man? Hope you've been well, dude. It's been a while. I got Rome Diggs in the house. Rome, hope all is well. Hope your son's doing well in real estate, by the way, man. Would love to catch up and kind of see how he's doing. As one of the things we're going to talk about today is two kind of main things. But one, I just read an article that Christie's is starting a crypto division of their real estate company, which is great. Obviously, as crypto becomes kind of more normalized, you're starting to see it more in the normal space. You're seeing bigger banks kind of accepting it. Obviously, the federal government is accepting it as well. And so as I've thought about that, it's actually not hard to buy real estate with crypto. Honestly, all you have to do, man, what's good, bro? Hope you've been well. Appreciate that. It's actually not hard to buy real estate with crypto, right? All you got to do at the end of the day is exchange whatever currency you're working with. Just exchange it into USDT. That's a stable coin. And then you can go ahead and cash that out, or you can work with a custodian that will accept those funds, trade those funds either into fiat, or if you're working with somebody that also will accept USDT as a stable coin, so $1 actually equals $1, that would be one way to transact kind of within the real estate space. What'll be interesting is if banks start to accept that as a down payment. That would be pretty dope. One way they could do that, again, is if you're working with a custodian, those funds could be sent to the custodian, and then the custodian can cash those in at that point for dollars, euros, whatever that you're going to be purchasing the home in, wherever you're going to be purchasing it. And then you could transfer that to the title company as the down payment. And at that same time, while you're doing that, if you're working with a lender that will acknowledge those funds as good funds and seasoned funds for that matter, then that's your down payment at that point. But really, shout out to Christie's for starting a crypto buying division. And really, to me, it's just a ploy because it's pretty fucking easy to do. It's just a way for them to grab some headlines. So I'm not even mad at them for doing that. But if that is something where if you're interested in, if you're sitting on a large amount of crypto holdings and you'd like to get into real estate investing, that is what I specialize in, right? And so I specialize in the Austin market and being hyper knowledgeable about the Austin market. And then trying to see like where's the best ways that we can deploy funds within Austin in the MSA. So that way your investment will outpace the normal, Austin investment. Man, shout out to Selma. We got Chris. What's up, Chris? John, hope you've been well, man. It's been a minute. Tim Landy in the house, man. Tim, one day I'd love to have you on here. Maybe we could do a 12 at 12 with Paul and Tim, where we could just talk about our favorite hoops. Tim will understand what that is because we've already done that before. But, guys, as we think about this and as cryptocurrency becomes normalized as an actual currency, it is going to be much easier to transfer those funds into actual fiat and then transfer that into fiat and transfer it into say less. Sometimes it's hard for me to say less when you're doing stuff like this, Tim. We're just a bunch of talkers over here. Yeah, but it's being able to transfer that into fiat and then using that as a down payment. The other thing you do is if you find sellers that are very crypto favorable, and you're a seller that's willing to accept fees as crypto versus dollars, you may be able to yield a higher premium. Prime example, right now, I have tenants in the Austin area where I'm accepting funds in Solana. I was actually able to get more rent on a monthly basis. I'm getting substantially higher. And unfortunately, tenant's probably going to hear this, but getting above market rent because I'm accepting it in a non-US currency, right? And so it's being accepted in Solana. And sometimes the problem with that is if it goes down 10% that following day, guess what? That's the hit that you take. But at the same time, that person then doesn't have to cash that out, put it into his bank. He just sends it directly over on a Phantom wallet, and that is a way to collect rent. Also, guys, if you're out there and you are, your main source of income is crypto, or if it's a side hustle and you want to start paying rent that way, hit me up. I work with a lot of investors that would be down to accept funds that way. There's obviously those that are crypto curious. I think you're going to see a lot more mainstream, and a lot of that starts with the federal government and creating different reserves and whatnot, stuff like that. One of the other things I really want to talk about is I don't know that those that don't know, but Elon just closed on 1,000 acres in Liberty Hill, which is interesting because he obviously has 2,500 acres in Del Valley out by like 130 and 71. And so as he closes another 1,000 acres in Liberty Hill, that he's saying that's where Tesla's headquarters is going to be, right? So one of the reasons why he's doing that is because the schools in Liberty Hill are going to be substantially better than the schools in Del Valley. It's going to be a while for Del Valley schools really to pick up. It's going to be great for your factory workers and blue collar, but when you start to get to your C-suite and kind of more of the white collar jobs, a lot of times schools really turn into a factor versus just location and proximity. And so that'll be something that I don't really think a lot of people probably saw coming. For the Liberty Hill area, certainly wasn't on my bingo card to see 2025 Liberty Hill get a 1,000-acre Tesla site. Shout out to them. It's from what Elon was saying, it's going to be hundreds, if not thousands, of jobs. And the thing that they don't tell you about that is what's called ancillary jobs, right? So for every Tesla job that comes out, let's say there's going to be 5 other jobs that spawn from that, right? So if it's going to create 500 jobs at Tesla, then there'll be another 2,500 jobs that kick off. Now you're thinking about your hairdressers, your bartenders, your dry cleaners, all the businesses that are going to need to service people in that area. And Williamson County is one of the fastest growing counties in the U.S. Obviously, Williamson County and Hayes County are the 2 biggest. And probably pretty grateful as well that there's just a bunch of water that just dumped into the lakes. Because that's really had they announced that 6 months ago with the amount of rain that we hadn't had at that point, there might have been an uproar. But now with Lake Travis being 80 to 90% full, I think that kind of helps soften that blow a little bit. Man, Stan, what's up, dude? Thanks for jumping in here. By the way, appreciate you. But that's a huge thing for the Northwest corridor, the North corridor of Austin, and really that kind of North MSA in that area. And it really kind of bookends, Highway 130, if you think about it, right? On one side of 130, you got the Tesla factories. On the north side of 130, you've got Tesla's, basically their headquarters. And they're also talking about doing like rocket launches and whatnot up there with SpaceX, which I think would be great to go up there with Max and watch the stuff that kind of pops off. And the timing is also great because within 1 week, you've got Tesla announcing 1,000 acres in Liberty Hill purchase and building. And then the week before that, you've got Tesla and Samsung partnering up to do a $16 billion project. As Tesla will be buying chips from Samsung, which is huge. And you think about that is a direct cash infusion to the Austin market as far as guaranteeing jobs in the future. And in Taylor, where Samsung is building their prefabs, they've got the ability to build 5 of them. Each prefab costs 50 billion, so that would be a $250 billion investment in the Taylor area. And think about where Taylor, you've got Highway 29 that cuts right into it, or Highway 79, which cuts straight into Liberty Hill and Taylor. So, you got to think a lot of those things have been kind of happening in the background over the past couple of years. And those, we got to ask ourselves, what are the other things like that are happening right now in Austin that make Austin a very attractive place to invest? We did we recently interviewed Kurt Watson, and he was talking about how there's a substantial amount of companies that want to announce that they're moving to Austin or that they're doing development in Austin. However, they're coming in from other cities, and currently their employees are sitting on interest rates that are in the 3s and 4s, and they don't want to move them. Where all of a sudden now they're sitting at rates at say 5, 6, 7. And those things are really going to hurt business, potentially, or hurt the employees at that point. But I think enough time has passed where they're like, look, this is the new norm and we have to grow. That's why you're seeing a lot more employers telling their employees that they need to come back into office. During the pandemic, obviously everybody got to work wherever they wanted to. And as much as employees would like to think that that is a much better, efficient business model, employers, I guarantee you, probably think differently on that, right? As far as working from home and whatnot. Man, we got Matthew in the chat, by the way, an amazing artist here in Austin. Guys, go ahead and give Matthew a follow, man. He's so dope. As an employer, I found that it's easier for me if I've got everybody in office to be able to go have that conversation with my marketing person, with my ops person, and we can get everybody in a room and have a conversation within 5 minutes, knock out something that would typically take a while to try to get everybody together. And so I know you're starting to see that. And I think as you start to see that shift back to people working in office, you're going to see the Austin market, but specifically the downtown Austin market and the urban infill market of Austin really start to spike, because that's really what's taken the biggest hit over the past, I don't know, let's call it 2 years, 3 years, right? As interest rates in 2022, the second half of 2022 were raised substantially by the Fed. The higher end markets really took a hit. Oh, Alyssa Gonzalez in the house. Alyssa, hope all's well. Man, hope you're selling some real estate out in Marble Falls, man. I know you're doing good stuff out there. Austin over the past, in 2024, we delivered 60,000 apartments in Austin, absorbed about 40,000. And we have about 60, 70,000 people annually moving to Austin. All those things are very positive, especially when you start to include unemployment rate and everything else, right? So unemployment rate in Austin, I think we're hovering at right now, I think it's like 3.4%. Texas is 3.9%. And in the US, I think it's at like 4.5%, somewhere in that range. And as we kind of continue to evolve as an economy, you'll start to see, because we can't always be in an up market, right? We're starting to see things kind of on a global level, maybe not a global level, but certainly on a US level. We're starting to see some news talking about how Miami is taking a hit. Other areas that were very very busy during the pandemic are starting to, they're taking a hit. A lot of those have been taking hits. But then what you're also starting to see now is those that weren't popping off during the pandemic, those really kind of caught up after the pandemic, right? So you got the Texas and Florida states just went off, and really the outside of the MSA of like your Dallases and your Austins continue to do well because you're able to add affordable homes. But when you raise interest rates so fast, and to give you an idea, there's different types of interest rates that we're talking about, right? So the Fed rate that everybody's talking about with Powell, that's the rate in which that banks borrow from the government. That is a much lower rate, typically, and it's a shorter term rate. versus mortgage rates are tied to the 10-year security, right? And so that is a rate that typically has a yield from the 10-year to whatever mortgages are. And so those two things are not really tied together, right? If the Fed drops the rate a 0.5%, it doesn't mean mortgage rates drop a 0.5%. It also, the way mortgage rates are, they're actually, a lot of the rates right now are baked in based on what the perception of what the Fed is going to do. That's why, like last year and years in the past, we'd have rates drop significantly when they thought they were going to, when they thought the Fed was going to reduce rates. And then when they didn't, rates shot back up quickly. A lot of that is because of just the perception of what's going to happen in the market. Hey, Linda, hope all's well. Thanks for jumping in here. We're just talking about real estate and talking about the Fed, Austin real estate, and all that fun stuff. And guys, this is an AMA as well. So please feel free if you have any questions about real estate or anything else, please feel free to let me know, as I'm just over here kind of spewing numbers at this point. But I think there's an anticipation that the Fed is going to drop rates 2%, or not 2%, 2 times between now and the end of the year. And why that's important, for example, is commercial loans and credit cards and lines of credit and everything are tied to LIBOR, tied to the Fed rate, right? And so then there's going to be a spread between what the Fed does rates at and what the banks then make in profit. And so if you've got, if they drop rates a 1/4 point, let's say they drop rates a 1/4 point in September, for every point reduction is about 12 to 14% in affordability when it comes to homes. Well, that's the same thing with commercial real estate and cash flow. Unfortunately, there's a substantial amount of commercial loans that are resetting over the next year to 2 years, as most commercial loans are fixed for 3, 4, 5, 6, 7 years, some 10 years. And those that were able to lock at a 10-year they're pretty happy if they lock at a 3.5 on a 10-year. Most people lock on a 5-year. And so those that lock at a 5-year, they're getting ready to reset, and their rates are going from, let's call it 3 to 3.5 to 7. And the difference there on something like that, to give you an idea, on a commercial property that is, let's say it's a $2 million note on a commercial property. And this is just the principal and interest. This isn't the taxes or insurance. Typically, too, commercial loans are at a 25 or 20 to 25% or 25-year AM. Let's say you're a $2 million property is the note, and you're at a 3.5%. Your monthly payment is $10,000. Well, let's say all of a sudden that goes to 7. Now your monthly payment is $14,000. So that is a 40% increase in your. That's a 40% increase in your monthly payment on a commercial property. Doesn't mean that you can go raise your rent 40%. It means that you're paying 40% more on a monthly basis. And that is a direct hit. Shout out to my wife, Denise. Denise is in the chat, by the way. I got to be all like prim and proper, That's a big deal. Think about what that does, right? That pulls, she's too cool for school. Sup. That just pulls liquidity out of the market, right? That money is now going out of the market and going in directly into banks for interest. And so it doesn't necessarily mean that you can charge more in rent. The rental market and interest rates and how much your payment is, those two things are mutually exclusive. There's no tie to that. What it does mean, happy to All right. Yeah. Denise, go ahead. If you want to go ahead and weigh in on interest rates, feel free. Certainly you've heard me talk about them enough over the course of the past 20 years. So would love to get your insight at some point. If you want to just go ahead and cue in real quick and jump in, we can just do a quick Q&A of your thoughts on interest rates. But also too, let's think about this. The Fed rate and what they're talking about with Powell is, as they reduce rates, that means that companies are going to spend more money. Because a lot of times companies don't like to spend their cash. They'd like to spend based on lines of credit, all the R&D and other things that they're doing. All that's going to be tied to that rate. So that's a big deal. Does it mean that mortgage rates are going to go down? Not necessarily. Unfortunately, mortgage rates a lot of times are going to be tied to people's perception of the 10-year treasury, and also tied to what's going on in the market, right? If the market is looking doom and gloom, a lot of times interest rates will come down. This is the first time of the past 6 months. This is the first time where I've seen, especially with tariffs and everything else, kind of the we don't know what the hell's going to go on uncertainty of the market, that interest rates didn't go down on the 10-year treasury. In this case, interest rates went up. Well, why is that? Because the 10-year treasury is based on people buying our debt and buying bonds. And with all this uncertainty, it actually caused interest rates to go up. So this is one of the first times where we have interest rates going up while consumer sentiment is going down. That is not, by the way, that is not a great recipe for real estate. And so that's why you're seeing in the news now, there's more sellers than there are buyers. And this is across the market. Now, that's the overall arching US market. Now, I will say when you get down to real estate, you want to look state by state, city by city, neighborhood by neighborhood, right? It can be as micro as street by street or subdivision by subdivision. And a lot of that's going to be based on pricing, right? Remember, guys, doesn't matter what market you in, you make your money when you buy in real estate. You make your money up front. You cash the check when you sell. I'm pretty sure Denise taught me that if she's still in here. She'd like to think she did at least. No, you make your money when you buy. It doesn't matter where the market is, right? If you're in a town or a city where there's positive migration of people, there's positive job growth, chances are there's also going to be positive real estate appreciation as well. And the thought on that is that if your real estate's going to be worth more tomorrow as it is today, people are going to think that they would, that's why they'll buy real estate, right? And if they think that it's going to be worth less tomorrow than it is today, then they probably won't. Now, there's a bunch of other factors with real estate as well, specifically like real estate investment. That's right. You make your money when you buy. I always say that. That's right, Denise. That's actually her tagline on Instagram. Make your money when you buy, Denise. There's a comma probably somewhere in there. Otherwise, it comes off real weird. But yeah, I think it doesn't matter in the market. But when you're thinking about investing in real estate as well, guys, you want to consider other things, right? I've got a client that I just showed on Thursday doing a 1031. They're looking at, instead of doing a 1031, I'm talking to them about doing an opportunity zone deal where they come in and buy 5 lots and they build, and their cash flow will be about $105,000 annually. And they live in a state with high state income tax as well, right? So that $105,000 in Texas, you don't have a 10 to 13% income tax like you do in some other states. Well, the nice thing is that with real estate, you also get depreciation, right? And so your depreciation can actually offset your positive cash flow on that investment, which is great. And so those are other things to include: equity capture, appreciation. There's a lot of other things that work within the investing in real estate space. But at the end of the day, you can either make money when you buy or lose money when you buy. And so buying it is the most important thing. Are you seeing a lot of subject to transactions? Subject to foreclosure or subject to like sale? Like, in other words, like if it's subject to the sale of another property. And Will, let me know what you think on that. Let's go down the first one. As far as subject to being, a property that's for sale, that is subject to this buyer. Basically, the funds are subject to the seller. Yeah. Okay, copy. Subject to underlying mortgage. Yeah. So it's the addendum is for, a property for sale. Basically, the buyer needs to sell another property before they can close on this one. And so it's a contingency, basically. So the buyer has a contingency. That's the way it's worded in Texas. And so then the purchase is contingent on the sale of another property. Seeing a lot more of those. Obviously, when sellers have the upper hand, you don't see a lot of those. As the pendulum starts to swing in the way of the buyer, you'll start to see more of those. Where it could be real dangerous is like if that first domino doesn't fall in the way that it works in Texas. If it's supposed to, let's say it's a lot of times if I'm writing a contingency offer, I'll do a 60-day close if I'm working with the buyer. And then that gives me time to go ahead and put the buyer's home under contract to sell. And then you got to look at it too, as far as leverage goes, right? So if you've got a property that's a contingency offer and that other home isn't even on the market yet, As a seller's agent, probably wouldn't accept that, right? As a buyer, you're hoping they do. But also the way that the contract in Texas works is if then me as a seller's agent, when I accept a contingency offer, dude, I'm trying my best to bring in another offer, because what that does is that basically if another offer comes in, the buyer, let's call it buyer number one, then has to put up more money to waive the contingency, or they just terminate and buyer number two comes in. And so that helps in the way of now, you're talking to other buyers. And the second that somebody else wants a thing, whatever it is, you're kind of validating any of the other buyers. I say, okay, this is something that somebody else wants to buy. So therefore I'm down to put in an offer. But yeah, no, definitely seeing more contingency offers for sure. And sellers actually willing to discuss accepting them. I will say on the seller's agent side or the seller side, make sure that you're doing your due diligence to have a good idea that whatever is going on the market is something that's going to sell. And if on the buy side, I typically like to wait till you're out of the option period on the buy side to submit, because that's what's going to give you the most leverage at that point, right? And so the shakier the deal, typically on the buy side, it means the seller is going to accept more. The more solid of the deal on the buy side, it means the seller is going to accept less, right? So it's just all a matter of perception and all a matter of kind of where the deal is at that point in time. But yeah, absolutely. I think you're seeing more than you would have 4 years ago, because I don't think anybody would have accepted one then. That's a great question, though, Will. Thanks for that. And guys, if you have any questions about contingencies, if you're a realtor out there and wants a better explanation, I'm happy to have like a 5-minute conversation to help you explain a contingency better to your clients as well. A lot of times I'll try to break it down to like buyer number one and buyer number two, so that way there you can really explain it in a way that people will understand it. Guys, again, thanks for tuning in. This is as in the buyer's deeded the property and the seller's mortgage stays in place. Man, so you're talking about like a wrap, essentially. Is that right, Will? Yeah, so basically Will saying as in a buyer's deeded the property and the seller's mortgage stays in place. Man, that is a slippery slope. Let's put it that way. And I can only talk in the way of me as a seller, why I wouldn't do that. As I, because I can talk from the first person in this, as I sell property personally, and I get hit up a lot based off of kind of stuff like that. Yeah, first stage wrap, right? So the problem with a wrap, and whether it's legal or not, there is what's called a due on sale clause when you go buy a home from, and CMG's the lender. There's what's called a due on sale clause, and a due on sale clause could mean you accepted money or you just deeded the property to somebody else, right? Well, what happens then if that person, that you deeded the property to with the wrap stops making payments? What if what if all of a sudden they lose their job? God forbid. And this has actually happened to me before, where somebody the day after closing gets into a car accident and passes away. People might be like, oh, those things don't happen. They actually do. And unfortunately, they've happened to me before. And so I'm just speaking from experience. So one, it would trigger a due on sale clause. And it's good if you're I mean, you'd have to be in a spot as a seller, in my mind, to really accept that. So if you're in a position where you can't get out of the home, that's something. Yeah, obviously there's a lot of attorneys that are drafting these up, and they are, for all intents and purposes, they're legal. But what happens again if somebody gets into a car accident and dies, and now all of a sudden the person that's got that loan with Fannie Freddie. All right. Denise says she's got to jump at a call, but holler if you need a phone-in expert to answer anything that stumps you. Love you. Oh, that's really nice. Thanks. Yeah, as you know, at home we call her the Encyclopedia Real Estate at home, which is Denise, my wife Denise. Really, that's where all my real estate knowledge comes from. Will, let me know, kind of as we're going back and forth on this, would love your thoughts. Obviously, you can go ahead and chime in, but I've having been in a lot of these crazy situations in real estate, that is something that could happen, right? And so I'm sure it's something that would be kind of more primed for specific sellers that need to get out of something. But I think we also need to coach our sellers is to say, this is what could happen. And then all of a sudden, how does that work? If now that seller who was counting on that buyer to make that payment no longer has the ability to make that payment for whatever reason, because the bank is going to require the payment, and it's all well and good while payments are being made. But the second that payments aren't being made, and they start to look into it, and all of a sudden now the person that's supposed to have this note doesn't have the note anymore, or doesn't have the ownership. How does that work? Oh, yeah, man. I mean, look, I'm for it, by the way, right? He says, yeah, I was just curious about creative financing to lock in the house at someone else's low interest rate. Obviously, dude, FHA and VA has got qualified assumable. So I think the first thing I would do, Will, if I was you, is I would start to research which loans are backed by FHA and VA and really start to reach out to those sellers. Because now they're sitting on equity, depending on when they bought, they might be sitting on good equity and a great interest rate. And like we said, every point in interest is about 12 to 14%. Man, what's up, Lord Finesse? Hope all is well. Like I said, again, you've got, for every point in interest rate, you're going to have 12 to 14% in affordability. So in that case, to Will's point, the prime example, my dad has a home in New Hampshire. He refied on a VA loan at 2.5%, which is so low, especially now if somebody wanted to buy his house. Not only has that house appreciated a bunch, but also the rate would be high fives, low sixes. And so, let's say it's let's just talk about the difference of a $500,000 house, say on a 30-year AM, and 2.5%. And this is just going to be the principal and interest at 500. You're looking at a monthly payment of $1,975, right? That's $1,975. Well, now let's put that up to 6.5. All of a sudden, now the monthly payment is $3,160. So that payment, shit, for lack of a better term, I mean, it went up substantially, $1,200 or more a month, just based on the interest rate. And so there's a huge value there in being able to assume those notes. And to me, there's an ethical way and unethical way to do business. And to me, like talking to somebody that's got a VA or FHA loan and being able to assume that part of it, that is something that's built in the system. If it's something where you're going to try to do a wrap or actually not close out the first lien and then basically make the payments on that property, but it's still in the seller's name, even though lenders say it's, lenders probably wouldn't be down with it, but even though, attorneys are out there doing it and title companies are closing it, it doesn't feel right to me. That's not something I'd be down to do. And as a seller, again, what happens if buyer number one gets into a car accident and dies? Now, all of a sudden, I've still got that note in my name. And guess what? The bank's coming to me. The bank's not coming to buyer number one. The bank is coming to me, Paul Smith, to get that closed. And if I'm in a situation now where I can't do that for whatever reason, who's getting the foreclosure? Whose credit's hit? Whose life is ruined? Probably mine in the short term because of that. Versus, and again, just because somebody says you can do it doesn't mean that it's good for everybody. It just means it might be good for one side. And so that's where the whole predatory thing comes into play. There's a way to make money in this business where you can do it where everybody wins versus just doing it where people are either, kind of taking people's equity or whatnot. But, it's out there and exists. I'm just not going to be pushing it personally. Guys, it's 12:45. We hit our 30 minutes. It's been a pleasure chat with everybody again. Thanks for everybody jumping in. Man, we got Lord Finesse in the house, by the way. That's huge, man. Salute, dude. Thanks. And if you ever want to chat about real estate, bro, hit me up. Tyler, what's good, man? Hope all's well. If you guys are up in the New Hampshire area, New England area looking for real estate. And Will, man, if you have any other questions, please feel free to text me. Happy to help any way, shape, or form there. Guys, again, thank you so much for tuning in. This was the 12 at 12. See you guys next Wednesday.